This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Ferro, about 30 seconds away from the start of trading. What you are seeing is that risk-off yield. The Nasdaq now down nearly 1.2%. Yes, this is because yields are higher. It is also because of the chip stocks in particular, not only with some of the supply chain disruptions and potential lack of demand, but also because of some of the rate sensitivity that you're seeing. Russell 2000, typically more indicative of growth, down only 0.3%, while the S&P is down 0.7%. Talking about those yields, taking a look at what we're seeing in the 10-year, it has risen to 2.75%. I remember when it was 1.75%, which was not that long ago. The euro gaining a little bit after that election. At least the first round in France showed that Macron did seem to be getting more support than some of the polls would suggest. And crude, watching this, down 4% as people look at what's going on in China with the lockdowns and the effect that that could have on slowing global growth. Joining us now with a look at some of the stocks moving at the opening bell, here is Abigail Doolittle.
Well, Lisa, certainly those rising yields pressuring stocks. We do have the stock indexes down on the open, as you just outlined. And let's take a look at some of the movers beneath the surface, one of them being Twitter. Well off of its pre-market lows, though, down about 2% at this point. And more recently, a headline came out that Elon Musk, despite the fact that, as we learned over the weekend, will not be joining the board, he can engage in talks with Twitter, including strategy and governance. In other words, discuss various options with the board. He can also increase his current 9.2% stake to above 15% if he chooses to do so. So more out on this, I'm sure. Tesla related in a way because of course, the shared CEO, at least the CEO of Tesla, Elon Musk, down 4% right now. It down in sympathy with news out of NIO, warning of delivery delays due to COVID restrictions. And that, of course, is weighing also on Rivian Automotive, down about 3.2%. Then you were just noting oil down about 4%, Lisa, at its lowest in 6 weeks. And related to that slowdown in China, that's taking the energy sector with it. ExxonMobil down.
Abigail, thank you so much. Treasury is also extending their decline, sending yields on the 10-year to the highest level since March of 2019, as we've been talking about throughout the morning, and playing a major role in this equity market. Bloomberg's Kaylee Lyons joins us now with more. Kaylee.
Well, Lisa, those higher yields tilting this equity market in a decisively defensive direction. That was on full display last week, where your biggest outperformer on the week was the healthcare sector. Actually had a record week to a record high. And some of your other classic defenses, the likes of staples and utilities, also outperformed alongside energy, which we hear time and again is acting as some kind of hedge potentially in this environment. Meanwhile, at the bottom of the pile last week, all of your technology-heavy sectors, information technology down 4%, discretionary, which houses Tesla and Amazon, down 3.3%, and communications, which houses the likes of Alphabet, was lower as well. Put it all together, and technology stocks, as measured by the Nasdaq 100, have lost more than $1 trillion in market value in just the past 4 sessions. And that answer, of course, logically comes back to those higher yields as the reason why. Not just higher nominal yields, but importantly, higher real yields, stripping out inflation. That is now just about 11 basis points away from positive territory. And that dents the appeal of high multiple stocks like technology and growth in particular, which is why you see tech stocks and real yields going in opposite directions, which we saw on that chart there. But of course, it's not just a problem for tech. Really, equities in particular could be threatened by the idea that TINA maybe won't be the case anymore, that maybe there will be an alternative. One more comforting sign for the bond market, though, maybe for equities, is the fact that the yield curve is no longer inverted. Instead, the 10-year yield, once again, about 20 basis points above that of the 2-year. That, in theory, a steeper curve should help the financials. But of course, we'll wait for those results around the corner, Lisa.
Kaylee, thank you so much. So we'll get into financials just shortly here. Margie Patel, Patrick Frizzetti, and Dan Suzuki still with us. But I do want to get a sense of to buy or not to buy big tech. Margie, what's your view on that?
Well, I still like the technology sector, even the semiconductor sector, because I think they have long-term growth. The price you pay for that long-term growth is very short-term, high volatility periods like we have right now. Many of these companies are at reasonable PEs, not some of the very high PE stocks. We don't have those. And also many of them are cash flow machines and have very attractive competitive dividends. So we think for an investor who won't be bothered about short-term volatility, that looks pretty good. So we like tech. We think healthcare is good. And we also like certain parts of the industrial sector, defense, also capital goods, as well as some of the basic materials, which I think have completely restructured over the last decade and should have secular growth, unlike we've seen in previous periods.
Patrick, do you view the dip that we're seeing in big tech as a buying opportunity, or is this sector still inflated as a result of some of the Fed policies over the past 2 years?
Well, as I said earlier, this is a change in leadership in the market. So in a rising rate environment, I believe you want to be underweight tech and you want to be overweight, more sectors that have frankly been in a bear market for 8 to 10 years, like the metals and mining sector, energy, and on top of that, I still like utilities and healthcare. So no, I still think you should be underweight big tech in this environment because it is a true change in leadership. And we'll see how the Fed responds. Hopefully, they're a lot more decisive than Elon Musk in the coming months.
Dan, I got to say, as I hear people talk about big tech, I'm sympathetic as to why valuations could go down, and yet betting up against big tech has not been a winning bet over the past few years. Do you agree that this is a change in the leadership in the market, or do you think this actually is an area for actual value, considering the fact that a lot of people view this as the safer aspects of equities?
Absolutely, Lisa. I agree with Patrick. I think this is a true change in leadership, and it's no coincidence this is happening alongside at the same time that you're talking about this move in yields and this change in liquidity. I think you think about big cap tech. I mean, tech broadly, we think is still in the midst of a bubble. And I think that bubble, still has a lot further to go before it ceases to be a bubble. You think about the backdrop. This is not the right backdrop to be owning these types of stocks. I mean, yes, they are great companies. But there were great companies back in 2000 that people thought their leadership wasn't going away either. It's the price you're paying and separating the investment from the story. In an environment where profits are slowing, these sectors do tend to be historically cyclical. In an environment where liquidity is tightening, these have been the biggest beneficiaries of improving liquidity over the past decade, and their valuations, we know, are very, very elevated. So we would not be buyers here. I think the biggest risk to people's equity portfolios is that these parts of the market encompass the majority of the market. Just 5 stocks make up a quarter of the S&P 500. Just 3 sectors make up 50% of the S&P 500. There's no diversification in people's portfolios unless you actively put it in there, and that means reducing your concentration in these parts of the market.
Dan, before we move on to banks, I just want to get a sense of how much further there is to fall. You start using the B word, bubble, and people start thinking of something more catastrophic, and I'm looking at Microsoft shares, for example, down already this year, more than 13%. What kind of downside are we looking at, and in what specific areas of tech?
Well, I think it's very broad. I mean, you go back to 2000, basically I think there were 65 stocks in the S&P 500 in the tech sector back then. All but 4 of them underperformed, and typically they were down 60, 70, 80%. Even the future winners like Amazon were down 96%, right? So it's not necessarily that these are bad companies. I mean, these are like cash cow, these are industry leaders, but it's the price you're paying for them, because people essentially have extrapolated the last 10 years, not just in terms of price performance, but in terms of the growth that they're going to get, the profitability improvements that they're going to get, and I just don't see that happening going forward. So in terms of downside, we're not sort of distressed investors doing company by company investment, looking at their balance sheets to understand what the underlying asset values are. But if you think we are in a bubble, and typically when the bubbles collapse, they overshoot. What's a typical bubble down? It's not down the traditional 20, 30%. It's usually a lot more than that. And I think that's the risk that's for a lot of these, the bulk of these stocks in this group, even if that's only to be oversold and then becomes a buying opportunity later.
That's a really bold call, which we'll have to revisit later. 20 to 30% potentially more downside risk for tech stocks. Meanwhile, we are looking to earnings, in particular bank earnings. The big banks are reporting earnings starting on Wednesday with JP Morgan kicking it all off. First quarter results, we'll get a read. Bloomberg Sonali Basak has been parsing through the expectations. What are you looking for?
Lisa, there's an enormous amount of dispersion when it comes to expectations for bank earnings. So you look at JP Morgan, which will be the first to report on Wednesday. Wednesday morning. There's almost a $2 billion difference in what analysts believe that they will make in trading. Same goes for Goldman Sachs. So there's a lot of uncertainty in terms of rates trading, in terms of commodities, but overall there's an expectation that the pie will be down. So the question is, how much can they beat those expectations by? Lisa, I also want to point out here the loan outlook, because while there is an expectation that loans will grow, there are a lot of questions about what a flatter yield curve will mean for net interest margins moving forward and the sensitivity of these banks' balance sheets. When you look at Ken Usdin of Jefferies, for example, he believes that NII will be lifted to more than offset weak fees, higher provisions, and lower buybacks. But with that said, all of those three things will be major headwinds for the banks.
Sonali Basak, thank you so much. Patrick, you're talking about a change in leadership and some areas to buy. Are financials one of them?
Right now, look, I think that I would say no, because I don't think, as you just quoted there, that net interest income is going to offset all of the sort of record, deal revenue that these banks were able to get last year. So I think it's going to be challenging for the banking sector. Again, you don't have a very steep yield curve. I think that's going to be problematic. And let's be honest, all of these things point to a risk of recession, and you don't want to own banks going into a recession.
Margie, do you agree?
We're pretty lukewarm on the financial sector. We think a lot of the areas are commoditized, overcrowded, and we don't see growth in a lot of these areas. So we're not very negative. We just think there's better growth opportunities in many other sectors.
And I guess that there's a question, Margie, about why higher benchmark rates, why higher overnight rates aren't offsetting the potential risks to the outlook, especially if you don't necessarily have recession in your horizon. How do you push back on that? How do you basically say, look, it is, but it's not enough to offset that potential downside?
Well, I think when you look at the corporate sector, the fundamentals, they're really in very good shape. The investment grade companies have a lot of liquidity, lots of cash on their balance sheets, so they're really immune to pretty significant rate increases. And same thing even with high yield so-called junk bonds. Those companies also have a lot of liquidity on the balance sheets that they all raise when rates are very low. Amazon today is another example where they can't get enough of the really low rate, long duration money. So I think that says the corporate sector is really not dependent at all on what happens if rates go up more than we're thinking, but rather their fundamentals, which still look pretty good. So that's why we're still pretty positive. We think that companies have great balance sheets, positive cash flow, and the economy is still going to grow. So that's a pretty good backdrop, and it'll make the economy a little bit more immune to these rate increases than we've had in previous cycles, because we don't have any bubbles in any particular area like we've had in other market cycles.
Dan, what's your view on banks?
Yeah, we're pretty positive. I mean, we did trim back a little bit in the last few weeks, but I think we're overall still pretty positive. I think, right now, what's going to drive their business, the core bank business, is loan growth and the profitability of those loans. Clearly, the yield curve has signaled, less profitability of those loans. But now, as you've been noting, this morning, those may have bottomed and start to go up. And so actually, as investors start to price in a steepening yield curve, that's going to benefit them. And on the volume front, the volume of the loans, I think is the outlook is pretty good. I think the economy is still, improving here. I think we've come from this environment where there was no demand because everybody's sitting on tons of cash.
Yeah.
Well, now the demand for, needing loans and needing money is going up. So loan growth should be pretty good.
Yeah.
Profitability maybe starting to improve. I think that'll be okay.
Thank you so much to all of you. Unfortunately, we have to go. Margie Patel, Patrick Frizzetti, and Tan Suzuki. Really wonderful insights. Coming up, COVID continuing its spread throughout China.
Certainly, the lockdown in China is going to exacerbate the problems that we have in supply chain. So that is putting upward pressure on prices.
That conversation coming up next. From New York, this is Bloomberg.
certainly the lockdown in China is going to exacerbate the problems that we have in supply chain. So that is putting upward pressure on prices, and certainly all the businesses that we talk to in my 4th district and elsewhere through the country are saying that, we've pushed out when we think the supply chain issues are going to be resolved, right? So not this year, now it's next year.
COVID lockdowns simply adding to a growing list of headwinds for inflation in China. Neil Shearing of Capital Economics weighing in on the country's growth prospects.
With or without zero COVID, 5.5% isn't sustainable. You then isn't achievable. You then layer on everything that's happening with Omicron and zero COVID, and I think it makes it even more challenging. It's going to be quite difficult to move the needle on the Chinese economy over the coming months.
Back with us is our own Michael McKee. Mike, really hard for the Fed to assess all the potential risks.
Obviously hard for the Fed to assess, but imagine being the People's Bank of China. You look at the numbers overnight from China, and they were not good. PPI up by 8.3% on a year-over-year basis. That's stronger than had been forecast by economists. And PPI is the number that we generally look at to give us some sort of idea about industrial production in China. CPI, more consumer-oriented, obviously, is up 1.5% on the year. That's an increase that's more than anticipated. A lot of that has to do with the lockdowns. So even though PPI is down a little bit from its peak last month at 8.3%, it's still a lot. And it suggests that the economy is slowing down. As Neil just said, 5.5%, their target seems unattainable at this point. And economists have now, as you can see, been marking down Chinese growth all year. Now it's down to 5%. Could they get to a 4 handle? Well, it's beginning to look like that's possible because, according to some experts, they are losing control or have lost control over COVID cases in many big cities. Shanghai, 26,000 cases so far. And you can see that chart there all the way over on the left-hand side. That was the original Wuhan outbreak. And now you can see what's happening in China. They don't have the natural immunity built up in the U.S. and in Europe because we allowed COVID to go through the population. Their zero COVID policy means a lot of people are exposed and vulnerable. And they also have a problem with their vaccine not being as useful against the most recent variants. So, Lisa, a lot of questions about what's going to happen in China, and a lot of those are unanswerable about what that then means for the rest of the world, but we can imagine it means slowdown.
Yeah, and Michael McKee, thank you so much. This is certainly what you're seeing in the oil market, with crude touching a 6-week low, and this is as a result largely of the story that we're hearing over in China, or at least that's what a lot of people are saying. Crude traded on the NYMEX down now 4.6%. Brent trading just under $100, $98.33, down 4.3%. For more, let's bring in Bloomberg's Javier Blas. I've been struck by the incredible volatility, Javier, that we've seen in oil prices. Now it's being attributed to the potential slowdown resulting from the lockdowns in China. What do you make of that reasoning, and frankly of how whipsaw the action has been in the crude market?
I think that China is certainly one of the factors, and perhaps the most important factor today. But let's not forget that there are also other 2 important factors weighing in oil prices. One is the release of the International Energy Agency strategic stocks combined with the U.S. SPR, which is going to put more than 1 million barrels into the market over the next 6 months. And also the fact that Russian oil, with difficulties but continues to flow into the international market, is finding buyers in Europe, but also finding buyers elsewhere, particularly in Asia, India, and China. And the combination of those 3 factors, lower demand in China, more supply coming from Russia than expected, and also the release of the SPR, is what really is driving prices down, which, as you say, has seen probably one of the largest swings ever in history, from almost $130 a barrel to less than 100 now.
I'm trying to understand this because a lot of people were talking about the tightness in the oil market, that as demand came back, as the world reopened, that we would start to see that tightness really affect the oil market more than anything with respect to Russia. Where did that narrative go, Javier?
I think that it's still there. I mean, we just have put quite a lot more oil into the market that we were not expecting. I mean, the release from the International Energy Agency reserves is huge. It's more than 1 million barrels a day of extra oil going there. And also the fact that the drop in Russian oil production and Russian oil exports is taking more than people anticipated. The International Energy Agency have anticipated by April we will lose 3 million barrels a day from Russia. It's looking like it's going to be closer to 1 million barrels a day, and that's making the difference.
So going forward, what do you think the swing is? Further on the upside or sort of further on the downside based on what you're hearing from analysts?
Analysts and consultants, oil traders seems to be bearish for the very short term, but let's not forget from now all the way until the summer, we are going to have increasing demand for driving and traveling around the world. Jet fuel looks very tight. Yeah. Diesel remains tight everywhere. So I think that perhaps for the next few weeks, couple of weeks, 3 weeks, we have a bit of weakness related to China, and then potentially we start to recover.
Javier Blas, thank you so much for being with us. Coming up, we've got the market-moving events that you need to be watching. That's next in our trading diary. Right now, we are watching yields climb, still hovering around the 2.75%. As Marky Patel mentioned, we are also watching that Amazon deal, including they are selling 40-year debt, setting a jumbo bond sale at a time of yields that are rising. Are they locking it in for potentially even higher yields ahead? From New York, this is Bloomberg. This is Bloomberg Markets, it's the open. We are looking at basically stocks where they opened at 1.2% declines on the NASDAQ. I find that the most interesting because of those rate sensitivities, and then also the S&P down about 0.8%. Really, the yield story has been driving the day, and really people have been ignoring the fact that crude is down 4.4% to $93.98. Time now for the trading dial. What you need to be watching this week, President Biden speaking with India's Prime Minister Modi at 11 a.m. Eastern, followed by Chicago Fed President Charlie Evans. Later this afternoon, U.S. CPI coming out on Tuesday, plus we'll hear from Fed Governor Brainard. J.P. Morgan kicking off Q1 earnings on Wednesday, Goldman Citi and Morgan Stanley on Thursday. And finally, an ECB rate decision. We are looking right now at markets that are trying to digest all of this, in particular the ECB. I got to say, German 10-year yields rising to the highest levels going back to 2015 gets your attention. And we are also watching the real yields, which are climbing closer to zero in the United States. This was Countdown to the Open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day, Monday, April 11th. Here are the top market stories we're following for you at this hour. Escalation warnings. Ukraine expects Russia to widen its offensive in the east this week, according to President Zelensky. Meanwhile, Austria's Chancellor Karl meets with President Putin in Moscow. We'll get reaction from the Polish ambassador to the United States. And Shanghai cases, they topped 26,000. China's largest COVID-19 outbreak in 2 years continues to spread despite an extended lockdown of Shanghai's 25 million people. And demand, well, it's taking a hit as restrictions in China weigh on a fragile global economy and strain supply chains around the world. Oil touches a 6-week low. We'll dig into the markets and how investors are digesting this wall of worry. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, it's a risk-off day in the markets, whether you look at the stock market, whether you look at the oil market. I think one of the key questions here is how much is this actually related to the Fed as opposed to the actual growth outlook? How much is this fears of the central bank story as opposed to fears of what China's lockdown might do to the global economy?
Firstly, you're Kriti Gupta. Just want to make everybody sort of aware of that.
I am.
I think we should nail that one down before we start the show. Look, Kriti, I think there's a bunch of things going on here that I'm slightly confused about. Oil down, yields up. Does that make sense? In some ways it does, in some ways it doesn't. Clearly China's having an impact on the demand story. Clearly that is going to ripple into what is happening with crude. It's interesting that we're seeing TI and Brent down similar sort of amounts at the moment. I don't know. There's a bunch of things going on here that I can't figure out. Are we more worried about inflation? Are we more worried about growth? What is oil telling us? What is the yield story telling us at the moment? It doesn't all quite line up to me. Does it line up to you today?
You know, it doesn't. And I think what's interesting here is that you are starting to see, yes, this kind of cross-asset correlations break down. But also when you look at the oil market in particular, it's not just about Chinese growth concerns, right? You are also seeing this tightness in the market, a lot of this open interest that has so far fueled oil prices higher. It's actually collapsed. Fewer and fewer people are actually trading in the commodity market right now. I wonder how much of this is a fundamentals question as opposed to simply a market plumbing question.
No, I think there probably is a plumbing element to all of this. If you take a look at the curve, clearly the biggest drop has been at the front end. You look at the rest of the curve, certainly versus a week ago, we are pricing oil lower really across the curve, but it's a much smaller amount. So further out, maybe the demand here isn't quite so great. So let's get to our question of the day. Does oil have a growth problem? Let's try and answer that now. Joining us, Paul Wallace, who leads Bloomberg's Middle East Energy and Commodities team. Micah McKee, also joining us, Bloomberg's international economics and policy correspondent. Paul, let me start with you. Why do you think oil is down?
Hi, Guy. The biggest thing today is without a doubt China. That's what is making traders more bearish today. They're looking at the lockdown situation in Shanghai. They see rising case numbers. They see no end in sight to the lockdowns there. And I think some of them feel, or they're a bit nervous, that China may have, at least to some extent, lost control of the pandemic. And they see a big drop in oil consumption in what's the world's biggest oil importer. So that's the biggest thing. Now, you can also look at the dollar, though. If you look at the dollar, I think the dollar's up for an eighth straight day. So that's another thing that's weighing on crude prices.
Mike, let's get you into the conversation here, because one of the other concerns, you heard Paul mention this, essentially China driving this problem. At the core of it, it comes down to the growth, right? In the last 2 years, I think China has been actually driving the growth story for the global economy. Now we're talking about deceleration in all the major economies around the world. Talk to us a little bit about what that does from the economic perspective in terms of the growth outlook.
Yeah, from the economic side, it's more a flip of the question. Does growth have an oil problem? And it has had an oil problem, particularly the price of it. And we're seeing that impact in the United States. We saw the Department of Energy report that oil demand is down over the last week or so as prices really begin to bite at the pump. Now, pump prices have started to come down, but Americans are still looking at oil as a problem. We get retail sales later in the week, and we expect a big gain at gasoline stations that will impact other parts of the economy. And that's basically the case around the world. The Europeans have even worse because they've got the war right on their doorstep and energy prices significantly higher there, particularly for natural gas. So you look at the economic impacts of all this, and they are strong. What we don't know is how long they'll last.
Mike, how different is the U.S. economy at 120 bucks a barrel and 90 bucks a barrel? If we do see China bringing oil prices down more generally, what impact is that going to have? What impact will that have in terms of the Fed's thinking vis-a-vis rate hikes? We've got CPI coming up tomorrow, clearly focused on inflation, but people are worried that we're heading a recession, and I'm wondering whether a lower oil price will stave that off.
Won't stave it off. It will ease concerns somewhat. We have a lot of inflationary pressures that aren't based on energy, including housing in the United States. And so we aren't expecting a major change in the trajectory of CPI for quite some time. Loretta Mester from the Cleveland Fed yesterday saying she doesn't think we get below 3% until 2024. So we're going to have an inflation concern, but the Fed has already committed itself to raising rates relatively aggressively. So probably the recent decline we're seeing in energy prices isn't going to have much of an impact on them, not for a while.
Paul, let's bring you back to the conversation here. I'm curious about what can actually be done to deal with this problem, right? If you have oil, perhaps in the long term, some very bullish views out there, talk to us about the ramp up when it comes to actually physical supply, whether it's from the United States, whether it's from the Middle East. The concerns seem to be the same that you see in a lot of other industries, supply chain issues, labor shortages. What is the timeline in terms of making sure we get all that supply back on the market?
Well, this is a big problem for the oil market at the moment, and it's something that physical traders, those traders that are actually moving, buying and selling oil barrels, this is what they constantly say. They say, look at the undersupply in the market right now. They put it, anything up to 2 million barrels a day at the moment, and they say it's far from obvious to see where the extra supply will come to. If you look at the U.S., shale producers are very much sticking to production and financial discipline, and what that means is they're prioritizing sort of giving money back to shareholders rather than raising output. And if you look elsewhere in the world, if you look at OPEC, there's some big producers like Saudi Arabia and the UAE that have the capacity to raise production pretty significantly and quickly, but they have all but said they do not want to do that. So it's pretty difficult to see where we'd get extra output from in the short term.
Paul, can you just do the maths for me? China has a COVID problem. What is that roughly worth in barrels per day? The first thing I read this morning was about Iran. Doesn't look like we're going to get a deal there. What's that worth in barrels a day? What is Russia out of the market worth in barrels? I'm just trying to work out where balance is here and what are all the competing factors in terms of the plus or minus into the market.
Yeah, I mean, the oil market is complicated at the best of times, but I think it's especially difficult to work out what would balance the market today, given all those different factors that you mentioned. China, as I said, is the biggest issue right here, right now. Some people think we could see a demand loss of, 1 million barrels a day or even slightly more from China alone for the next few months. Iran was probably going to be, probably would be a ramp up of about 500,000 or 1 million barrels a day in a few months after any nuclear deal is revived. But obviously, what we're seeing are very pessimistic remarks coming out of both the Iranians and U.S. officials. Interestingly, that did nothing to push up oil today. So I think the market is almost no longer pricing in an Iranian nuclear deal, or at least it's not pricing it into anything like the same extent that it was a few months ago. And if you look at the U.S., some people think the U.S. can raise production by about 800,000 to 1 million barrels a day this year, but it's extremely difficult to work out what's going on, because not only are there many factors, but they're quickly changing factors as well.
And that doesn't even take into account some of the moves you're seeing in other parts of the commodity space. As always, we're going to continue to monitor that for you. Thank you to Bloomberg's Michael McKee and Paul Walls for your time and for your insight, as always. Coming up, Morgan Stanley warns that the bond market and the S&P 500 are too sanguine about the economic outlook. We'll discuss that with the CIO of Kestra Investment Management, Kara Murphy. That conversation next. This is Bloomberg. Morgan Stanley's chief U.S. equity strategist, Mike Wilson. Well, he's out with a note today saying that bond markets and the S&P 500 are too sanguine about the economic outlook. Let's bring in Kara Murphy, Kestra Holdings CIO, for her take. Kara, thank you so much for joining us as always. Talk to us a little bit about the economic outlook and how markets are really digesting this, because something that's really of interest to me is this difference between demand destruction and an outright recession. There is a difference between decelerating growth and a complete contraction of the economy. What side of the spectrum is, say, the S&P 500 on?
So this is a really careful question, right? Because you have to get it just right in order to figure out where risk assets are going. If you think back to the beginning of the year, we had this theme of downshifting. Growth was torrid in 2021. We knew that things had to slow. Throw in a war in Europe, even hotter inflation than expected, a more aggressive Fed. Naturally, you're going to have a lot more market volatility. That said, we still think that the economy is going to sort of like thread this line between slowing growth and recession. So we haven't gone into reverse. We're just still in that downshifting camp.
What does that mean for your portfolio? Where do you want to be? Because it's interesting, as we slow down, you would have thought the yields would come lower. They're not. They're going higher, Kara, because the Fed is going to step on the brake pretty hard. You've obviously got an earnings season that is coming up. We still don't know exactly what companies are going to be telling us, but they're likely to be fairly cautious. How do you position around this? Do you want to be defensive? Do you want to be in bonds now that yields are starting to pick up? Just tell me what the perfect portfolio looks like right now.
Well, we're looking at a couple of different areas that look very interesting. One is travel and leisure. So this is where it might be a little counterintuitive because we're seeing real consumer income slow. But if you think about consumer spending patterns, they're shifting very dramatically from durables, where they were really accelerated during the pandemic, to services. Travel in particular has a huge amount of pent-up demand. We're starting to see RevPAR pick up. And in fact, we're starting to see U.S. hotels that are raising dividends, increasing buybacks. There are a lot of positive signs.
Kara,
can I just jump in? Can I just jump in and talk to you a little bit about what's happening with travel and leisure? One of which is input costs are massive. So you've got we've just been talking about the oil price. The oil price is down a little bit today, but the oil price is sharply higher. U.S. carriers don't hedge. And everybody I talk to in the travel and leisure sector at the moment tells me that they cannot get the staff that they want. Look at what's happening with JetBlue. It's having to reduce its schedule because of staffing. How big a problem is that going to be for your thesis that travel and leisure is going to work out?
Yeah, these are certainly headwinds across, and even hotels are having a hard time hiring, restaurants are having a hard time hiring. But this has been a story for a while, right? This is not new. They've been contending with this for the last 12 months. That doesn't mean it's going to resolve overnight, but as the market starts to look forward, earnings estimates are still really conservative. We're only expecting RevPAR to get back to pre-pandemic levels in 2023. So I think there's enough pessimism already baked into these names where they can outperform.
Kara, I'm so glad Guy mentioned the input cost, because once again, I was going to bring it right back to the question of the day, which was essentially, does oil have a growth problem? But what's interesting to me is the way that the energy sector is really being used. It's almost being used in a way as an inflation hedge, but also a little bit of a defensive sector. If you are bearish on the rest of the stock market, the one spot of green that you will actually see in the stock market on a risk-off day will likely be energy. At least that's been the trend in the last couple of months. I'm curious, though, when energy goes from becoming a defensive sector to sorts, and I don't mean defensive in the classical sense, but defensive in terms of inflation hedge, to going back to an actual value bid. When does that transition occur?
Well, so it's interesting. I mean, again, you look back to 2022 when you had this really torrid growth. Energy was by far the best performing sector. Now it's performed really well so far this year for slightly different reasons. And in some ways, it doesn't even matter. But when you look back in particular over previous inflationary periods, inflation is the one, energy is the one consistent that outperforms during inflation. So on top of that, your previous guests were talking about this gap between supply and demand. You've increased geopolitical risk. So you have these kind of like classic economic challenges, you have geopolitical challenges, and you have this fear of inflation. So I think there's a lot really to conspire to keep that sector performing well.
Kara, a question coming in from one of the audience, and I think it's a really germane one. Are you also comfortable with the hotel sector, the travel sector more broadly, considering the debt levels that have been taken off? Yields are rising, and some of that will have been locked in. But nevertheless, are these heavily indebted sectors going to struggle as yields continue to pop higher?
Well, I think there are certainly pockets of the market that are going to that are more heavily indebted, that are going to be a challenge. That's not just in the hotel sector, but that's elsewhere. But I think within the hotel sector, I would favor those with the stronger balance sheets. You saw some who were able to take advantage of some restructuring and be able to bring down those debt levels. So I think there are still some really good opportunities in there.
So you talked about the hotel sector. Let's talk about the airline sector as well. This is a space that's very close to Guy's heart. He mentioned the lack of hedging there, but we should also talk about the rebound in terms of actual travel. We are still not back to pre-pandemic levels. I believe some of these airlines, at least in the United States, have only just turned cash flow positive, I want to say at the end of last year, even in the first quarter of this year. I'm curious about what that means for the future at a time when you could start to see continued variance, when you don't have business travel 100% back yet. How does that really work when it comes to seeing a long-term view for the airline sector?
Well, I think when you're investing in airlines, you always have to have a very long-term view, right? Because these are really cyclical stocks. But again, if you think about this resurgence of demand, I mean, I know my family had numerous canceled vacations over the last 2 years. We're slowly kind of like building up those vacations and plotting them over the next like 6 to 12 months. And we're doing that knowing that there could be other variants out there. There could be some unexpected things that happen, but we're going to dip our toe in. We're going to start to get back to like somewhat of a normal life. And I think this experience is happening all over the world. And, you know, earlier you were talking about COVID outbreak in China and concerns about growth there. Yes, it's a concern, but we've seen this play before, and we know that people come back. And in fact, they come back after shorter and shorter times after each of these waves.
It would be remiss of me if we didn't talk about the data that's coming up tomorrow. CPI is expected to come through in the United States tomorrow at 8.4. Later on in the week, we're going to get PPI data, 10.6%. Inflation is clearly very high and is likely to remain so at least for a while. Kara, when you think about what we're going to get from the earnings story, how is that going to get baked in? Clearly, top line with this kind of inflation should be relatively good. Do you think top line's going to be strong enough this earnings season to compensate for what's going to be happening in the middle of the P&L?
So over the last couple of quarters, you know, I've described this cycle as being on fast forward. Everything has happened quicker. So that makes all of these earnings seasons that much more important, because you know, it's almost as if the earnings that they're reporting for the previous quarter don't matter anymore because the picture has changed so much. So I think it will be really important what we hear from management, because they have a much better view about what's happening on the ground. And you know, I'm going to tell you a secret, that CPI and PPI reports are going to be really ugly. It's going to be ugly. But it's a question of how the companies can manage through these. And I think that we'll get a lot of information over the next couple of weeks.
Yeah, I guess the concern is the PPI is higher than CPI, which may ultimately mean that these guys are having to take some of these costs and take it on the chin. Kara, great to hear you're positive on the airline sector. Thank you very much indeed for joining us. Kara Murphy of Kestra Holdings, really appreciate it. What do we got coming up for you? The European Union's top diplomat telling member nations that Ukraine needs more weapons, and it needs them in a matter of days, not weeks. We're going to have the latest next. This is Bloomberg.
America, this is Bloomberg. The war in Ukraine rages on.
President Putin's invasion is brutal.
Turn to Bloomberg for up-to-the-minute reporting from around the world and analysis of what it all means to you.
The intention here is to increase the pressure on the sanctions front.
I think the United States policy is that the sanctions continue until President Putin is no longer there.
For continuing coverage from Ukraine and around the world, keep it tuned to Bloomberg Television and Radio.
We need air systems, aircrafts, tanks, and other armored vehicles, artillery systems, and ammunition. And you have something that can be indispensable for us. You have it. Armored vehicles, anti-aircraft, anti-tank, anti-ship weapons. When it comes to survival in a war aimed at the complete conquest of the people, it is necessary to give principled answers. The usual rules for the supply of weapons must be reviewed, and action must be taken quickly. It is necessary to help.
President Zelensky addressing the South Korean parliament earlier today. The message is clear, really clear. Weapons, weapons, weapons. President Biden is going to push India to take a tougher stance on Russia today as well. He's going to be speaking with the country's Prime Minister, Narendra Modi, a little bit later on. Joining us now from Washington is Bloomberg's Anne-Marie Hordern. Let's talk about that India meeting. How aggressive do you think President Biden is going to be? He has pushed back against the Chinese. Now it's the Indians' turn. What's the message going to be?
Well, I think the message is going to be one that we've heard outright in public. President Biden's top economic advisor, Brian Deese, last week said that they warned India about if there's a future more strategic alignment with India over, say, Western countries. At the same time, you've seen a lot of public displays of outcry from Western nations, especially when you have India last week abstaining from the vote of revoking Russia on the UN High Commission of Human Rights Council. Yet at the same time, reporting that we have is behind the scenes, there does seem to be a little bit more of an outreach from the United States on trying to make sure they can help India. Two massive issues really come to play. One is the fact that India is still buying Russian oil at a steep discount, and not just that they're buying it, they're also, we don't have a finalized view of what they're going to do on this, but there is this discussion that they are working with Russia so that they could pay in rubles, and they can basically skirt around the system of these banks that were de-SWIFTed. The second, of course, is weapons, and India has looked for years to Russia for weapons. Their future supply, they're going to need Russian machinery and technology to make sure they can replenish those weapons. Potentially, this is somewhere the United States can help, but it'll be more expensive for India.
Anne-Marie, I'm so glad you mentioned the weapons piece of it, because as we know, India is the biggest buyer of Russian weapons. I am curious about another connection, though, and that is to Syria this time. I think there was a story that crossed the terminal that the General Alexander Dvornikov, he was notably the commander in charge of some of Syrian troops, or Russian troops in Syria, I should say, in 2015, 2016. He has now been put in charge of the forces in Ukraine. What is the take in Washington about that development?
Well, I think they look to what he did in Syria, which is he really moved the tide of the war towards Bashar al-Assad's advantage. And this is where you saw civilians being attacked and cities just absolutely put to rubble when he was in Syria. He's known as, quote, the butcher of Syria. And for his work in Syria, he was also awarded a hero of the Russian Federation. So this is someone that is also admired by some circles in Russia at the moment. The United States considers that this is going to be very similar to what you saw in Syria and also what you saw in the United States in places like Bucha as well. I'm sorry, Ukraine.
Well, Anne-Marie Hordern, thank you so much, as always, our Washington correspondent. Coming up, crucial U.S. inflation data comes out tomorrow and Wednesday. We'll discuss with Austin Goolsbee of the Chicago Booth School of Business. That conversation next. This is Bloomberg. hour into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the moves, seeing a little bit of red on screen this time around.
Indeed, red on the screen for sure, Kriti. We have the S&P 500 down about 1% near session lows. That NASDAQ 100 down even more, down 1.8%. What makes this board so interesting, though, is even though we have these pretty solid stock declines, it's not necessarily a risk-off day if you look at it from the standpoint of bonds, because you also have haven bonds selling off. You can see that 2-year yield up just about 1 basis point, the 10-year yield up more. So, of course, 210 is steepening once again, 22 to 23 basis points. So that brief inversion, but this certainly has investors worried as rising yields pressured the valuations of stocks. Also pressuring stocks maybe today because another risk asset that's dropping, oil. Take a look at this long-term chart of oil. You can see a massive gain basically since June of 2020. But the reason that I wanted to show this longer-term view is you can see that the uptrend to some degree is starting to be broken. You have that massive, topping pattern. I'm not even quite sure what to call that, but it does look pretty brutal. Right now, oil below its 50-day moving average, confirmed to go to its 100-day moving average, and probably still that 200-day moving average. Net probably to 80 or maybe substantially lower. On the one hand, that's good relative to inflation, but again, if from a true risk standpoint or assets qualification standpoint, oil's a risk asset. So right now you have it selling off, not over this time period, but on the day. Finally, let's break it down stock-wise, Guy, because we are going to see Twitter. It's hanging on to its gains, been all over the map. This, of course, is Elon Musk is not joining the board. This means, of course, that his stake can go above 15%, but he will be talking to the board. Investors seem to be trying to figure out what this means for the shares of Twitter. Wells Fargo and other banks higher with rates up 2.4%. Tesla, on the other hand, NIO, they had to cut their production on the Chinese shutdowns. That is weighing on the EV space overall. And then finally, NVIDIA cut by Baird with some issues for their supply chain as well. So lots of different moving pieces, as always, Guy.
I think we're all trying to figure out what Elon Musk's intentions are when it comes to Twitter. Probably also the SEC taking a lively interest in that. Abigail, thank you very much indeed. Let's talk about the data that we are going to get this week. Massive week in terms of the inflation numbers that we're going to be getting. Tomorrow we've got the CPI figures coming out. We've got basically rising consumer prices and factory prices because we get PPI coming out later on this week. So just give you an idea of the expectations here. Those are some of the component parts. But the CPI is expected to come through at 8.4%, up from 7.9. PPI is expected to come in at 10.6, up from 10. Austin Goolsbee, former chairman of the Council of Economic Advisors, joining us now to give us his take. He was obviously there during the Obama White House. He's now an economics professor at the University of Chicago's Booth School of Business. Austin, great to see you. Look, we're going to get a pretty chunky inflation number. My question to you is this as high as it goes? And as it starts to come down, where do we settle out at?
Yeah, but both of those are important. It feels like this is about as high as it's going to be. As you know, in the U.S., when we report the inflation data, it's a trailing average of the last 12 months. So 11 of the 12 months, we already know. All that happens is we drop off 1 month from a year ago and add a new month as we come in. So all eyes really should be on what are those new months coming in and how high is inflation. When you've got a city in China of almost 30 million people that's in total lockdown, you got to think that the supply chain issues that we've been dealing with over the last 2 years are not going to resolve in the next month. And there's obviously still the war going on in Ukraine. So both of those are question marks. If it weren't for that, I feel like this would probably be around the peak, but we don't know from the others.
So how long can these issues last? The supply chain issues, the commodity issues coming off the war in Ukraine, and the commodity issues that were there before the war in Ukraine as well, in addition to the other issues you just laid out. Give us a kind of worst case scenario of how much longer we can actually expect perhaps this inflation that is persistent before it goes into reverse.
There is no worst case scenario if you think about it, because if you keep getting new variants of the virus and places around the world keep going into lockdown, it could go forever. Now, that said, it does feel like the capitalist system is pretty good at trying to figure out what, if you give the information and you give some certainty about where we're headed, they're pretty good at then trying to figure out how to get around the constraints. So hopefully by the summer, you will see relief. You've already seen some relief on the oil price side. The events in China have thrown us a little bit for a loop. Russia defaulting on its debt, it was expected, yet is still gonna have to be processed through the market. But you're seeing freight rates come down, you're seeing oil rate prices come down, you're seeing some relief on a bunch of the supply chain. And as we get out of the virus fear era for the U.S. economy, and people can go back to spending their money on services instead of on physical goods, that's the root of what went wrong in the U.S. The prices of physical goods soared through the roof because the supply chain cannot handle that level of demand. And if we go back to spending money on services, I think there's going to be some relief there.
Austin, I'm really glad you mentioned the China piece of the equation, because that's something that is perhaps even more persistent, changing that zero COVID policy, changing the mass testing program, and the port closures that have so affected those supply chains. I'm curious, though, what it's going to take, or what the timeline looks like in terms of redrawing some of those global trade routes. We know the Biden administration, for example, has been very vocal about bringing some of that production that has been abroad, especially in Asia, onto U.S. soil. What does that do to the long-term view of the United States and perhaps the globalization that might come apart?
I know a lot of people have been talking in that way. I'm a little more skeptical that once we're out of the COVID era, that these changes that have been forced upon us in the supply chains are going to be permanent. I think when COVID is over, we're going to rediscover how we got to the lean supply chains before, which is it's cheaper and there's big economies of scale. But certainly in the short run, we have been spending a year and a half scrambling on the supply chain trying to get out of single source supply. We've had some decent success. So if this had happened in Shanghai a year and a half ago, I think it would have been more devastating than it's going to be now, precisely because we've kind of diversified a bunch of the supply chains. Some of it's come back to the U.S., some has gone to Mexico, to Vietnam, Indonesia, different places. So we can diversify a little away from China. But it's the virus. It always seems like the swamp thing. It's done, it's past us, and then out of the swamp comes the hand to pull you back in. And it feels like in China they got to get some real vaccines, and they got to get them quick. Yep. and get people vaccinated. Otherwise, they're going to be facing these kind of lockdowns, because these variants are massively more virulent and spread faster than the first iterations when they had the zero COVID policy.
Austin, what does this all mean for the United States? What does it all mean for the Fed? Let's talk about the economy. Larry Summers was on Meet the Press Sunday. He said nothing is inevitable or certain in economics. Yeah, I think we can probably take that. But the Fed will have to be extraordinarily skillful and lucky to avoid a recession. How high would you put the odds of a recession next year, Austin?
I don't know what the exact number is. I don't think Larry's wrong to say that it's elevated risk. I mean, we've got wars, we've got respreads of COVID, we've got inflation, we've got a bunch of things that are tough challenges. At the same time, the economy for last year grew at an epic pace and is a very strong labor market. And like I say, if we could get past the COVID era and go back to something like what existed before this COVID recession began, I think it would be fine. The Feds, you got to have some sympathy for them, because this wasn't like any previous downturn. So there's no model. You can't just go look at the data from 1984 or from 1991 or from any previous period to get a good lesson of what the Fed should do, because this wasn't a recession that was driven by cyclically sensitive sectors. The demand for durable goods went up during the downturn. The demand for housing went up during the downturn. So the normal channels that monetary policy works through are irrelevant. Now we're all trying to figure out how fast are people going to go back to getting their hair cut and going to the dentist. And that's not something that the Fed has a big database
Well, okay.
of experience to consult.
Let's talk a little bit about the labor market. The jobs number is massive right now. Clearly, there are lots of open positions. We're going to get into the earnings season next week for some of the industrials. You get some of them starting this week, obviously, with the banks, but I think you're going to get into the thick of it next week. We're going to hear from companies that they're struggling to employ people. You listen to the airline sector. They can't bring people back fast enough. They're having to cut capacity because they don't have enough people to bring online. As I say, the JOLTS number is enormous. What gets people back into the labor market right now? What fills some of those positions? Is it a higher inflation number? People have got to go back to work because they can't afford to get the groceries. Is it people's portfolios coming under pressure because the Fed's hitting the stock market? What gets the labor market back in balance, do you think, Austin?
It could be those, but I still think the most important thing is their fear of the virus goes down. Their schools are reopened and they can send their kids to daycare or to school. They're not taking care of a sick relative. They themselves are not nervous that they're going to get sick from a customer or beat up by somebody because they're trying to enforce a mask mandate and stuff like that. So I think as the health part of this gets better, the job matching part is also going to get better. Now, I would also point out that while business is saying we can't hire anyone and talking about the wage price spiral, the share of national income going to corporate profit is up, not down. So for whatever amount wages are up, it's not up as much as the corporate profits are up. So it doesn't really look, it looks like a very strong labor market, but it doesn't look as tight as what you would think from the language that people are using about how hard it is to find people. You'd think that they would be raising the real wage of workers, and they really have not been.
Austin, you mentioned the labor part of it. Let's talk about where else companies are actually going to be spending their money. Something in focus is going to be their profits. Are they going to be investing it in terms of capital expenditure? Does that help the U.S. economy's bottom line?
It would if they do that. I mean, so far you've continued to see high dividend payouts, share repurchases, things like that, which kind of points to their feeling that they don't have as many big investment opportunities. I was struck to see that Pulte, one of the big home builders, they're making money. The prices of housing is way up. You would have thought they would be investing in building more houses, but they're paying out a big dividend.
Right.
I kind of don't. I don't understand the full dynamic there. I do expect that with oil prices up as much as they have been, you're likely to see, if those prices remain high, you're likely to see a resurgence of capital investment in the energy sector. I think you will see resurgent capital investment in the housing sector because the prices are inviting it. And that will contribute to strength. There will still be pretty substantial fiscal drag as we roll off the American Rescue Plan going into 2022. So that's going to balance it out. So overall, I think the growth rate of the U.S. economy is going to be substantially down from what it was last year.
A lot to chew on. Austin Goolsbee, thank you for breaking it out all down as always. He's the University of Chicago's Booth School and former chairman of the Council of Economic Advisors. We thank him for his time. Coming up, Elon Musk says no thanks to joining Twitter's board. His latest move has left renewed speculation about his intentions for Twitter. We'll get to the details next. This is Bloomberg.